You're welcome back. You're still watching Business Morning here on Channels Television. We head straight to the banking sector in Nigeria. And we start with the findings of Augusto and Co. They note that there's been positive resilience shown by the Nigerian banking industry in the full year 2021 as the industry's loan portfolio grew by 21%. And that's despite the weak economy and regulatory constraints, and return on equities at 23%. We have joining us now Ayokunle Olubomi, Head Financial Institutions at Augusto & Co., to tell us how they arrived at this and what this means. Good morning, Mr. Olubomi. Thank you so much for joining us this morning.
Good morning. Thanks for having me.
Yeah, so tell us how you arrived at this positive resilience by the banking industry in Nigeria.
Okay, thank you very much once again. If you notice, 2021, we saw a rebound in the economy, right? With the scale down of the restrictions that we had because of the pandemic. And this was reflected in the banking numbers, right? And we also saw in 2021 a better understanding of the operating terrain by the banks. So what we realize is that we now realize that, look, the industry loan book grew by over 20%. Not only that, the bank leveraged the increased acceptance of electronic banking channels by Nigerians and grew the electronic banking income by over 60%. Right? The investment income that typically dominates the bank's non-interest income was also resilient in 2021. Overall, the non-interest income grew by over 30%. The banks also maintain a lead on costs, taking lessons from what we saw during the pandemic. The cost savings that the bank recorded during the pandemic in 2020 continued into 2021. So although on absolute term, right, the industry's operating expenses grew by 11%, but the cost to income ratio, right, which shows how efficient the banking industry is, right, actually even dropped by 200 basis points to 64%.
Okay, but can't we say that, we're looking at 2021 now. 2020 was a very peculiar year. Can't we just put this as a base year effect?
Not only that, right, because remember that the income is also for a period. Right, so it's not only about because if you check the performance on 2020 wasn't that bad. 2020 wasn't that bad in terms of the income. Remember also that for the bulk of 2020, the banks were shut, the branches were closed down, people were working from home. So the banks recorded a lot of cost savings. So that's why you can realize that in 2020, relative to 2019, the results wasn't that bad. So what the bank actually did, the banks were not even under pressure because costs were actually even going. We're actually using this to increase their income.
All right. So your findings at the end of it, you're forecasting a 23% return on equity at the end of this year. That should encourage investors into the banking sector, right? Or is it too late? Is it too late to get in?
I will say yes. I will also say no, because despite the expected improvements in the industry's ROE, but also don't let us forget that the headwinds in the banking industry is actually still there. The cash reserve ratio is still there, and we all know what inflation is actually saying. Look at the energy sector; we could see the high cost of energy. So the challenges are still there, and don't let's also forget that this is looking at industry-wide. Some banks will actually record more growth, while some banks won't do as well as others.
And then you anticipate 16.5% year-on-year loan growth this year also. Have you taken into consideration some of these factors you just mentioned, the headwinds?
Yes. I think, like I mentioned earlier, what we are saying now is that most banks are having a better understanding of the operating terrain. Because as a bank, whether you like it or yes, you have existing shareholders that you need to deliver returns to, irrespective of the headwinds that you actually have. So you see most banks looking for opportunities to make income despite the prevailing headwinds. Right? For example, in looking at the loan book, we believe that the loan book will actually grow by over 16%. Why? Because despite the headwinds, banks are looking for opportunities. For example, if I tell you like 5 years ago, a lot of banks will tell you that they don't actually lend to the agriculture sector. But what we've seen over the years is that almost all of the banks, even the most conservative, they are looking for Where are there opportunities? Where are the ones that we can even align the opportunities to our what? To our risk acceptance criteria, right? For example, like I also mentioned to you, banks are also focusing on electronic banking income and even agency banking. You will notice that a lot of banks are even now focusing on also looking at the profitability of branches. The branches that are not making profits, they're closing it down. The one that they couldn't close down, they're scaling down operations there just to be able to focus on efficiency and how to even make more money.
And we hear banks are also collaborating with fintechs these days.
Yes. What you see is that for most banks, right, the strategy around fintech has to do with collaborate and compete. So meaning that in as much as possible, can you collaborate with the fintechs, right? And areas in which you can compete, you can also compete with them. Because the fintechs also realize that, look, they can't run this show all by themselves. The banks have been here for decades. They understand the terrain better. So most of them actually, so it's a win-win situation for most parties, for both parties.
Well, you hinted on this earlier, the cash reserve ratio being high at 27.5%. I mean, a lot of people have talked about this, but of course the CBN also has its own vision and plan, you know, placing it at this point. But what impact is this 27.5% CRR having on the real economy?
Yeah. Okay. First of all, looking at it from the banking industry, if you ask any bank MD now, they will tell you that one of the greatest challenge, if not the greatest challenge they're having now, is the cash reserve ratio. And a lot of banks in top management, they dread Fridays where you have the CRR debits, right? And because let's forget also that the banking industry is basically in the business of financial intermediation, taking money from the surplus and also giving to the deficit. So out of the money that you're taking from the surplus segment of the economy, if a portion of it is held sterile by the CBN, under the guise of the CRR policy, what you realize that the amount of funds available for the banks to lend to the real sector will actually reduce, right? So although the growth that we saw last year and the one we are projecting this year, without the CRR, the growth will have been significantly higher than that. So number one, like I mentioned, is going to reduce the amount of loans that is going to the real sector. Don't let's also forget that the CRR is held sterile by the CBN, meaning that bank hands no return on it. Even the special bills that the CBN give to the banks, realize that the interest rate on it is actually very, very negligible at 0.5%. So what we see also is that for the loans that the banks are giving us, for the other opportunities to actually lend and make money, banks are actually what? Maximizing that. So that's why you realize that in as much as possible, you see that the fees, charges are low, right? It's also going to be higher, right? Because the ones that the CBN is holding sterile, don't forget that some of these funds are also purchase funds. I need to pay interest expense on it. So as a bank, the ones that I'm lending now, I need to try and even maximize what I can actually even get on it. So you see that the cost of banking, the cost of banking to the general public is also going to be higher because the banks are trying to even maximize income from the available sources.
But I guess the CBN also has inflation to deal with, so they also try to mop up some of those cash from, from the economy to balance things up.
Exactly. Yeah, I agree with you, right? Because I agree with you that the CBN, at least they know what they're actually looking at. They're looking at inflation, also looking at the exchange rate. But at the same time, the banking industry is on what? Is on the receiving end of some of these policies.
Yeah, but I guess they can balance that up with this hike in the savings deposit to 30% of MPR. You think that will encourage more funds to go to the bank, more savings, and make a change in all of this?
Yeah, looking at the increase in the savings rate is a two-way thing. There are two ways in which you can look at it, right? One, some might argue that it can encourage savings, but let's even think about it. At less than 5%, where you have inflation of about 19%. I don't think it's going to be that significant. But what you also see is that for the banks existing savings stock, savings deposit stock, you notice that the interest expense on it is going to increase. But having said that, what we realize is that for most banks anticipated higher interest expense in 2022. So most of the banks have actually factored that into their plans. Right, so we don't expect this this increase in savings interest rate to actually even significantly adversely impact the banking industry. Let's also not forget that in terms of the intervention funds, right, the income on it, the interest income on it was also increased from 5% to 9%. percent. So the bank will also make money from that particular aspect also.
All right. So with this now, if we were to have this conversation early next year, what do you see? Do you see a stronger, more resilient banking sector, or do you think some of these factors will taper that growth trend?
Yeah, if you look at the banking industry, like I mentioned earlier, a lot of them are having a better grasp of what is happening in the environment, right? And then let's also not forget that this is a cycle that we've actually seen over the years, right? The challenges with FX. Don't forget, we're also here in 2016 where we had the issues with FX, then when we had higher inflation, right? So it's a cycle that the industry has actually even passed through. So to answer your question directly, yes, we think the industry is going to be more resilient. And let's also not forget that a lot of banks are also trying, those that think that they need to shore up their capital. They're actually even putting up different initiatives to raise capital, either as tier one capital, either as additional tier one as perpetual bonds, also tier two capital. Right. So you see that a lot of banks are also trying to even create enough buffers and putting up different initiatives to ensure that they're actually resilient and they actually prevail relative to the given this particular prevailing headwind. So to answer your question directly, yes, the industry has resilience and we see the industry to be more resilient in 2020 by this time next year.
All right, it's good to know my money is safe in Nigerian banks. Thank you so much. All right,
Thank you
that was
very much.
Yokunle Olubumi, Head Financial Institutions at Augusto and Co.